On today's episode, we are going to take a look at Walmart. They just reported earnings earlier today, so let's get started. The first thing we want to take a look at is this company's stock price performance. This company was up pretty good at the beginning of the day, but it ended up with a sell-off and it's down about 2% closing right now. So the stock price is sitting about $124. Now let's take a look at the past 6 months performance. And for most companies, I have been taking a look at February 20th because on average, that's when the big effects started to happen in the market. So in February 20th compared to now, this company is up about 6%. So this is one of those few companies that have done great for investors. And this company actually did not take a big dip compared to other companies. And one of the main reasons was Walmart is pretty much a grocery store. So they were open at all times. And that actually ended up helping the company out and not see that big drop in the stock price. And before we go any further, guys, don't forget to hit that subscribe button, the thumbs up, and the bell. It helps the channel out so much and I truly appreciate it. I actually just did a video on Home Depot, so make sure to check that one out too. I'm doing videos as often. It's definitely at least one video a day, but days like today when cool earnings are coming out, I do at least two. So if you guys want me to take a look at anyone, let me know in the comments right now. Alright, so now let's take a look at the earnings results for this company. Quarter one non-GAAP earnings per share were $1.18, which actually beat by 9 cents. GAAP earnings per share were $1.40 and it beat by 33 cents. So we did see a nice beat in both non-GAAP and GAAP earnings per share. Revenue for this company was $134.6 billion, which is up about 8.7% compared to the same time last year, and they actually beat expectations by $3.7 billion. And that is pretty insane that they did see an increase of about 8.7% in revenue growth. All right, so next let's take a look at some highlights for this company. Walmart reports comparable sales in the United States rose 10% in the fiscal quarter one. And this ended in April 30th. So quarter one for this company is pretty much while the whole shutdown was taken into place, right? Shutdown in the United States happened in middle of March. And some companies that we have taken a look at in the past few weeks, they were not truly affected by the shutdown that quarter because it did not take place the quarter did not end during the shutdown process. But we can see Walmart is one of those companies that has actually is actually showing the true results of the effects due to COVID-19. A huge increase in that comparable sales growth was led by strength in the food, consumables, health and wellness, and some general merchandise categories. Average ticket prices were up 16.5% during the quarter, while transactions fell about 5.6%. And this is actually something we saw in Home Depot, and it actually makes perfect sense. Right now, people are not going to stores just to go to stores. They only go to stores when they really need to, and they are reducing the amount of times they go in stores. But when they go in there, they make sure to buy everything they need. So what would that happen? If they buy more stuff at once, it's going to drive the average ticket price, but it's reducing the amount of times they go. So it's going to reduce that transaction. And that's why we see the average ticket price up 16.5%, but we see that transaction down 5.6%. They do have Walmart International, and Walmart International sales were up 3.4% compared to the same time last year. And if you guys don't know, Walmart also owns Sam's Club, which is a membership type program similar to Costco, and Sam's Club sales increased by 9.6%. The biggest news was e-commerce sales in the United States rose about 74% during the quarter, and that's actually a pretty good news, especially since Walmart has really been trying to really build its name in that e-commerce market. And the COVID-19 is definitely helping out companies like Walmart, Home Depot that have been ready to take advantage of it. And the COVID-19 is helping them see that growth there. We do see that gross profit rates did decline by 66 basis points. And again, the main reason is because most of the sales increase in revenue were by foods, and foods usually have a lower margins. So even though they sold more revenue, that kind of decreases the overall profit rate. They're still making money out of it, but the average rate has decreased a bit. Walmart, just like other companies, has withdrawn its guidance for the fiscal year of 21, and this is similar reasons that we're seeing everywhere. Even though things are looking good for Walmart at the moment, We don't know how long and how much of an impact the COVID-19 is going to affect the middle class, the lower class. And right, with people losing all these jobs, right now the stimulus check might be helping to some extent, but what if that stops, and what if unemployment still keeps increasing? There's still so many unknowns in the overall economy of the world. Next, I just wanted to take a look at the historic revenue growth that this company normally expects. In 2019, this company grew merely 2% in revenue compared to 18. In 18, it grew about 3% compared to 19 to 17, and 17 it grew about another 3% compared to 16. In 16, it actually only grew by below 1%. So this company is on average does show revenue growth, but most of that revenue growth is in the low single digits. So it is actually pretty impressive to see a 8.7% year-to-year revenue growth for this quarter. Next, let's talk about Jet.com. And Jet.com was the main way Walmart bought Jet.com a few years ago, and Jet.com was supposed to be the way Walmart combated Amazon, and at the moment it was actually a pretty good idea, and I still think it was a really good idea for them. They do say they did discontinue Jet.com, and the main reason is because there has been a huge strength in Walmart.com. So there's no point in confusing your customers of going to Jet.com and going to Walmart.com and just confusing them. Just have one brand and one website. But one thing to note is this company, Jet.com, was, I think, a great acquisition because it brought a lot of leaderships to this company. I think here they mentioned, in this article, they mentioned that the acquisition of Walmart gained a team of online talent, and the founder of Jet.com is now the chief executive officer of Walmart United States e-commerce business. So they pretty much bought the talent and bought the infrastructure, and now they don't need it anymore. They're just going to continue to develop Walmart.com. This company did spend about $755 million in response to COVID-19. They spent a lot more, but this $755 million were used to be paid out to Walmart hourly associates during the quarter, right, to entice people to continue coming and working at the stores. And today in the earnings call, they did mention something that I thought was pretty cool, and they said that right now there has been about 3 phases of this whole COVID-19. He said initially customers stockpiled on groceries and household essentials, right? So when the whole COVID-19 started happening, people were just rushing out there to buy groceries and household essentials. The second process later, he said that they started to buy puzzles, video games, bicycles, and things to keep them entertained. Like office and exercise equipment, and just new stuff to just overall help them work at home. So they also bought home and decor improvements. And this is actually, I think, pretty insightful to see how the overall market is coming. And they're saying now at the end of the quarter, the retail saw a bounce in spending in just random items, such as clothing, TVs, and toys. So that's actually a pretty good, I think that's actually pretty good too. If you guys know of any companies that might take advantage of stuff like this, of knowing this information, I think it's just really good to know. So the first phase was buying groceries, buying household essentials. The second phase were people being bored, so they bought things to be fun. The third thing is people didn't lose their jobs, people got stimulus check, and they just used that money to boost up the economy. All right, so next, let's take a look at this company's balance sheet. If you guys have been watching my channel, you guys know this is my favorite document to take a look at. First, total current let's just take a look at assets. Total current assets for this company. So this is April 30th of 2020 compared to last quarter, which ended January 31st. So right now, total current assets were $63.3 billion compared to $61.8 billion. So an increase of about, $1.5 billion. That's not that big of a deal. A big portion of it is this company did see an increase in cash and cash equivalents. Last quarter, this company had about $9.5 billion in cash. This quarter had about $14.9 billion in cash. And we did see a decrease in inventory. So inventories last quarter was $44.4 billion. This quarter was $41.2 billion. So it does seem like this company did sell off a nice portion of its inventories. That's why we see a nice boost in cash. And it does seem like this company at the moment is not trying to restock. I wonder if some of those items were seasonality because that was during the holiday seasons. So there might be no real reasons to increase it. Or if this company right now just sees is just trying to be smart with the inventories and seeing that it doesn't need to purchase everything. There's only certain items that it needs to restock. Next, let's take a look at this company's total assets. Total assets last quarter were $236.5 billion. This quarter was 232.9. So an increase of a decrease actually of total assets by about $3.5 billion. And that to me is not that scary of a thing, because most of that total asset decrease comes from just depreciations of their equipment, depreciations of their real estate, and that's something you expect to see. So next, let's take a look at this company's total liabilities. So total current liabilities has increased. Right now it's sitting about $82.6 billion compared to last quarter of 77.8. So an increase of about a 4.8 billion dollars in total current liabilities. But there was really no big difference here, except that the main reason here is dividends payable. Last quarter, this company did not pay off dividends. This quarter is expected to pay about $4.5 billion of dividends. So that's pretty much all that increase in total current liabilities. Next, let's take a look at this company's long-term debt. And long-term debt has decreased by about $700 million. So right now, it has about $43 billion in long-term debt, while last quarter had 43.7. So we are seeing a decrease in there. We did see an increase of total current liabilities, but remember, a huge reason for that was because of the dividends that it needs to pay off. But unfortunately, what we do end up seeing is we did see a small decrease in total assets and pretty much flat line in total liabilities. And now let's take a look at this company's balance sheet. I mean, total assets is a lot higher than total liabilities by a long shot. But this company, I want to say a company like this usually does not have a lot of cash because it ends up using its cash to buy inventories, and that inventories ends up selling to build up cash, and that transaction just keeps happening. But this company has enough total current assets to pretty much kind of pay off its total current liabilities. If I was to give a grade to this balance sheet, it would be like a C minus. A C minus. It's an okay balance sheet. It's still passing, but it's nothing crazy to go raving about. Finally, the last thing I want to take a look at is this company's valuation. And normally for a company like this is going to be actually priced pretty similar to Home Depot. This is a company that has an okay balance sheet, is paying dividends. It's a company that's with the balance sheet, it's not going to go anywhere. It's seeing a decent amount of growth, especially in the e-commerce business. So normally a company like this, somewhere between the low 20s is where I would give it on the forward PE ratio. So in 2022, this company is expected to make $5.41. At this current stock price, that gives this company a forward PE ratio of 23. So like I mentioned, right, for me, in the low 20s would be okay. But that to me just tells me this company is okay value right now. I don't believe it's undervalued, and I don't think it's overvalued. So for me, again, this is not advice, this is just my thoughts. I feel like I can find another business where I can make more money on with my investments. This doesn't mean if I invest in Walmart, I wouldn't make money. I do believe you can make money anywhere. But right now I feel like my money spent can actually go in another company where I feel more comfortable with the growth. If this forward PE ratio was probably below 20, maybe in the high teens, even in for example 19 or 18, now I would be talking about definitely investing. But right now it's actually valued pretty similar to Home Depot in that low 20s forward PE ratio, which I think shows that they're okay valued. So that's it, guys. I hope you guys enjoyed this episode. Let me know what you guys think. Make sure to post on the comments, and don't forget to subscribe, hit that thumbs up, and hit the bell. Take care and have a good night.